The Bend Apartments, 312 unit Class A 2024 build apartment complex that we are acquiring at a large discount due to our relationship with this highly motivated seller. In a market we already own properties in and know very, very well, in a market that's experiencing high growth and demand right now. My name is Chad Sheeler, founder of Focus Capital, and thanks for being on this call to watch. We're very excited to share with you the recording of our live webinar presentation on Focus Capital's newest opportunity for investment and final for this year 26. In this webinar, we cover everything from how we're getting this discount, the business plan, the market, the risks involved, the returns, and live Q&A at the end. Be sure to watch the whole thing. This opportunity is open to accredited investors only. Let's dive in. Well, welcome guys to the webinar here this afternoon. Thanks for taking your time out of your day. I'll go over the Bend Apartments. We're very excited here from Focus Capital about our newest acquisition. As you may have gathered from the materials, we already own a couple properties within 10 minutes of this area. We bought those last year from the same seller. And we'll get more into the story and how this all unfolded with our relationships and how we're getting this discount. But I want to give a quick welcome and introduce myself as well as Jared and Chad. Myself, a lot of you guys already know me. Some of your new faces here. I'm the founder of Focus Capital. I started on my own years ago, back in 2017, began my journey really as a way to solve my tax problem for myself. I spent about 20 years in the credit card processing industry. I did pretty well at that, but wanted to find a way to offset taxes, which is also a way a lot of our investors come into real estate too for tax benefits. Did a few deals on my own with my own capital, made a lot of mistakes there, all lessons learned. Then I formed the Focus Capital officially in 22. Now we've done, 14 deals so far, exited 4 of those. We'll get more to the track record later on in the full cycle deals as well. But Jared, go ahead and give yourself an introduction, and then we'll go with Chad.
Hi, I'm Jared Shum. I run investor relations here at Focus Capital. My main job is to make sure that investors have all the information that they need to either make an investment or have the information on any of their current investments. One thing that we pride ourselves here on Focus Capital, amongst others, is really the transparency and frequency of our reporting. My journey to being in investor relations actually started as being an investor, being in your guys' shoes. And I've interfaced with people that are very communicative and are always telling me about my investments and what's going on, whether it is, an obstacle or a quick win. But what is really frustrating, when you're in an investor seat is when you don't know what's happening. You can really trust the team that you've invested in. You can know that, your investor dollars are safe. But if you don't know what's happening, you only hear from them once or twice a year. Sometimes there's that new voice in the back of your head that's, gnawing away at you. So something that comes from my desk is we do monthly and quarterly reporting on all of our properties. And we make sure that we keep in touch with our investors. And that all is part of my job here.
And then
Thanks,
I'm Chad,
Jared. Yeah.
and I'm Chad Olson, VP of Investments, been with Focus Capital for over 2 years now, handle all the sourcing of our potential investments in those deals, finding those, working with the brokers and our relationships, underwriting those deals, the debt sourcing, and then work hand in hand as we hand that off to our asset management department to manage the investment going forward.
Thanks, Chad. Appreciate that. For the audience here, Chad is on vacation with his family in a great area there, but he's hopped on board here to do this webinar with us. So thanks a lot, Chad. Appreciate that. Let's talk for a minute about the track record. This is one of the big things that people look at with a real estate operator of who they're going to go invest in. It's very important, not only track record, but also skin of the game and what's their local presence there. But it is important to have those full cycle deals. As I mentioned before, our first 4 early deals that were fully funded by myself, we've already exited those full cycle. These were all value add deals, higher risk than core plus by many measures, a lot harder work to get those done, but we were able to exit those at some really great returns. A little bit shorter hold period than the typical 5-year hold period. Chose to take that capital I had there to deploy to larger assets that could be more valuable and to be easier to manage. A lot of this journey was to go from the smaller properties to larger properties and to be able to manage more effectively. But 4 exits, we have 1 more coming up here in about a week on our 5th exit here pretty soon. And then our current portfolio, we've acquired a mixture of value add projects and core plus projects. We've done one development deal as well. All of our deals are currently performing. They're distributing. We have a couple refis happening on assets. So really exciting news for Focus Capital portfolio. And actually, yesterday we had a team meeting with our performance of our portfolio, and we're up 10% quarter over quarter on net operating income portfolio wide. So very exciting here. Jared, let's go over the opportunity next. So I'm going to give you just a really big picture on kind of my thoughts on the opportunity and why I chose to pursue this deal and why we're going to acquire it. It makes a lot of sense for us in this area. We already know the market. That is probably the biggest benefit to us is we've already been in this market for the last year. We know how the Southern Indiana market performs. We've already been operating Heritage and Gateway within 5 to 10 minutes away of the Bend apartments for the last year. So we've seen it happen. We've seen what the supply is doing. We've seen what the competing properties are doing with concessions. They're removing those. Our properties are fully occupied, very, very well, cash flowing, distributing higher than ever now before on current distributions to investors. And really, the local presence means a lot for this area to have 650 units in one area. We can establish a lot more density and grow that quite well. Tax advantages. This property is unique to where this has a built-in property tax reimbursement every year of roughly $500,000 a year. What that means is this is already in place through 2040. So for the next 14 years, we have that discount on the property tax bill, which will help investor returns quite a bit. Third thing really is the discount we're getting. So we always measure basis as a really strong metric to acquire properties on as a way to increase the downside risk protection. We're getting about a 23% discount on this property to what it would cost to replace today. Alongside that, this is also being acquired at a discount to relative other sold properties in the area, just giving us that in-place discount going in, great basis going in to where we can be in a better position. Don't have to worry about buying a property at the top of the market, top of the price point, and always trying to fight for that income and revenue growth. But high level in the deal, it's pretty simple. This is a roughly 15% IRR, which really translates to roughly a double your money projection over a 5-year period of time. And we'll get into those return projections here in a little bit. But great cash flow on the way, great cash flow out of the gate year one, great cash flow average over the whole of the term. 8% preferred return to investors, which gives you a priority on kind of your repayment on your investment. We're raising $19.7 million from investors. We've got a large general partnership co-invest of 10% of that amount. So roughly $2 million is being funded from the partnership and principal team. Minimum investment, $100,000. Average is like $200K at this point. So with that being said, Jared, let's go to the next slide.
One thing that I wanted to add, Chad, while we're still on this side, just for those that are paying attention, one of the big advantages on this is that tax advantage. And with that, our tax adjusted entry cap rate, which isn't reflected here, but will be reflected on the slide deck that we send out, is actually a 5.96% instead of a 5.28%. So what that means is, like Chad had said, with that property benefit, that cash flow goes directly to the investor distributions, and it really helps improve the NOI, which then also increases the property value as well from a exit and an acquisition perspective.
Yeah, great note, Jared. Thanks for that. All right, let's go over the property overview. Chad Olson.
Yep. So piggybacking off what Chad said, this is a A-class asset right in the major retail corridor of Clarksville. We are very familiar with the product type and this area with owning the 2 other assets in it. And we bought it from the same developer, right? And this is their crown jewel, their best one yet, fully amenitized, 312 units. They worked the design over these different iterations to get to this point. And that is a big reason why we were so interested in taking it down. Like I said, 312 units. We have a mix of 1s, 2s, and 3s. We are heavy on the 2 bedrooms, but that is the units that we're seeing the most interest in most of these markets that we're in, whether that be Kokomo down here to the Southern Indiana. And then we have some 3 bedrooms to offer larger families. Going back to those amenities, you can see kind of the pictures along the right to the bottom left. That is going to show you the the really top-notch leasing center, really open concept. Tenants have access to that at all times. A very, very large fitness center, and a great resort style pool. And then, as I was saying at the bottom, that's Clarksville Veterans Parkway. It was a major infrastructure improvement down in Clarksville that added a lot of value. And we sit right at the end of it, where we're right next to a Target, Sam's Club, Walmart, Chick-fil-A, some other high-end retailers that really attract you to a solid location like this. And then we'll get into a little bit, but I'll make a mention of it now. It's like we're right west of the major employment center, which is River Ridge Commerce Center. We'll have a couple slides on that. So when it comes to the business plan on this property, it's much of like we said, we've done this 2 times over already. We're going to come in, we're going to improve marketing, we're going to take the rents and the leases from where they're at currently and mark them to market. This deal, part of it has been a long supply story in the area where we've seen it kind of burn through. That's why we purchased the other 2 assets when we did and how we did. This deal had a little bit of a tough time leasing up with just the sheer size of it, but it is now operating at 96% occupancy while we're taking it over here in the next couple months. And so now that we've hit that thing, the concessions can burn off. We're seeing that at other properties. We're seeing our ability to increase those rents at the other properties. And as I said, this one is fully amenitized. It's a more idyllic location, so we should be able to get a premium compared to those other 2 properties. We'll be working on the other income lines. So right now, we've been lucky enough that the current owner has implemented a bulk internet package plan. We implemented those 2 things at Heritage and Gateway, and it did take some time to get full penetration. So we're going to have the advantage of them already getting that baked in to a certain extent, and then just taking that to the full 95, 96%. And that kind of goes downstream of that: RUBS, valet trash, insurance reimbursements, and the like. And then kind of below the line in expenses, we're going to see reduction in expenses from sharing operations across our other properties. And we'll be able to maintain and keep those expenses low going forward is one of the big advantages that we see. And then again, repeating the big benefit that we have is assuming that TIF, tax incremental financing income that's going to come from a reimbursement, reducing our tax year going forward through 2040.
Thanks, Chad. I think this might be a good time to actually mention the story behind this deal behind how this deal came about. And we'll go into Gateway Crossing and Heritage Square here in a minute with how we acquired those from the same seller. But Chad will tell you here in a minute, we acquired these last year, and what really translated to with the Bend Apartments is we've been pursuing this for over a year now. We actually tried to buy it a year ago at the current price right now. The seller, the big thing here is the seller has been a really awesome developer, great builder. He's not loved the management side of things, the operations. And that really is a sticking point for him. There's some partnership challenges there, right? And he would tell you the same thing if he was in front of you today. But really keen on relationships, because we already acquired Gateway Crossing and the Heritage Square Apartments from him directly and did that on time and did very well at that. We developed a relationship with him directly to now acquire the Bend. He felt very comfortable with us that we would execute and get this done on this timeline and do it well, to where he was willing to take maybe a different offer from us versus somebody else, because he had assurance, he had that surety of close that Focus Capital would get this done. Chad, why don't you go over the Gateway Crossing and Heritage Square deals?
Yep. So Gateway and Heritage, these are 2 deals that we acquired last year. And it's part of the whole story going into that. That's where we proved ourselves. Heritage Square, we were kind of second best. There was a different offer that came in on that, and we started to work that process through at the beginning of last year, closed that out in May. That transitioned to Gateway. Around that same time, as Chad talked about, we made our first offer on the Bend, because again, we really like these deals and we would have liked to buy them all 3 at the same time if we could have. But we've done this whole thing to get to here, and it's been a nice progression each time. So Heritage, we closed in May. Gateway, we closed in October. Learned lessons on each one, figured it out on each one. And I think that kind of shows, and I'd like to point you in at the revenue increases. So we've experienced those revenue increases over our ownership, like I said, just of a year, just a little over a year on Heritage, and then several months now on Gateway. And for this exact reason is why we were kind of excited to get the Bend when we did at this time of year. When we were coming into March and April, we really started to see the market finally turn. We started to see that supply story play out where absorption and all that supply that had come on in years prior during the COVID years, as we've seen kind of across the rest of the country, burn off. We're not seeing any new supply really come in. There's maybe one project on the horizon. And these units have been really absorbed. Most of the properties are sitting around 95, 93% occupied or higher. As I mentioned, the Bend is now at 96. So concessions are coming down and rents are going, and that's exactly what we saw at Heritage and Gateway. So coming into this deal, seeing their progression to their full lease up potential, now we're going to be able to do the same thing that we've committed to on that. And then, like I said, expense wise, we're going to be able to share employee staff. We're going to have scale against contractors as we work through these different projects. And that's going to provide some really, really large cost savings. Or on the long end, it's going to be able to reduce any kind of increases that you would normally see through expense inflation by having that scale in the market. So this is what I was talking about when it comes to employers. This side of town, this side of the river, the Indiana side, has been really growing quite a bit. A lot of major employers, a lot of manufacturing, a lot of these high blue collar jobs is what's been kind of the growth in this side of the market. Several years ago, they decided to make a big investment into the River Edge Commerce Center. It's kind of outlined in the top right of that picture. And this area is hundreds of acres. It's delivering 8,000 jobs. And this is a lot different than any of the other job announcement stories that we've heard over the last couple of years. This one's real. 8,000 jobs have been delivered, and they've already signed on for phase 2 and so on. The next announcement has been anywhere from 12 to 16,000 jobs in this area. Companies are doubling down. Meta's gone in. A few other major manufacturers have come in. And so this is really changing the entire demographic over on this side of town. And Clarksville has been, a big beneficiary of that. As I said, that Veterans Parkway was a big infrastructure expansion, a lot of good retail there. The only other spot that's, I would say, equal or better is over in Jeffersonville. So it's very easy access to get around. We're also only about less than 15 minutes to downtown Louisville. So as people want to take advantage of the bridges and get over to the Indiana side where it's a little bit less cost for taxes on your personal income and on a property side, which is a benefit to us, you have very easy access to get across there. And we should benefit it from a little bit cheaper cost, safer area than downtown Louisville for a lot of these people. And so the River Ridge Commerce Center has been a big job grower. We're seeing it. We have a lot of people that work over there that are at our Gateway and Heritage houses, and we plan on seeing the same when it comes to the Bend.
Yeah, thanks, Chad. I had a couple quick note here about the River Edge Commerce Center. I read some articles last week about this, and they've got 6,000 acres there, and they've not even used 2/3 of that so far. Maybe it's only half so far of their planned development there. So there's a lot of runway here for this River Edge Commerce Center, which is just 12 minutes away from the Bend Apartments, within driving distance. A lot of our tenants will be living here. They work in the area. And the economic impact so far has been $3.6 billion so far that this area has generated. Over 80 companies, 13,000 employees, 20,000 regional employees supported in this area. It's really been a big part of this growth of Indiana.
Absolutely. So now getting into the rent comps. So as I said, there's been some really solid supply that's been brought here. A lot of great A-class deals, Slate, Flats at River Ridge, Laurel, Arbor Place, Lakeside Gardens, Jeff on 10th, Walcott, and Current 812. And you can kind of see where a lot of these things were delivered, 23 to 24 and 25, right? And 24, this is the same thing with our property here. And so that supply kind of came to a head, and that's what we saw. But as you can see, these kind of occupancies have really been getting there. Slate's moving up. The Jeff on 10th has finally reached there over 93%. And that's a really premium deal. And what I'd like to focus you in on is just kind of where we're at with average rents today and where we're market to market, right? And so right now, the Bend sits kind of at the lower end of the range, and we're just moving to the middle of the range of these great comps. And because of that, because of the basis that we're getting in on, because of that, all those reasons is why we feel really comfortable about just moving those rents up to where market is. And as I said, as we've hit this occupation kind of thing and absorption has really picked up, we're going to start seeing those rents at the other properties increase, and we should benefit from that natural increase that's going to continue to rise. And the same thing is played out in the 2-bedroom comps as we move to the next slide. And as you can see here. And when it comes to it, a lot of these solid comps, like the Jeff on 10th, that's also in that major retail node. You are seeing several trades of these ones, whether it be the Slate or the Jeff on 10th, that are at a higher premium right now that are under contract or going under contract than the basis that we're getting in here. It goes back to that story of replacement cost, and it gives us more defensibility about where we're going to move our rents to and where we're getting in an entry price.
Chad, I think when I saw these two slides, what stood out to me the most is we're acquiring the Ben apartments at a current rental rate that's far below the average.
Yep.
And even after our 2-year plan of taking those rents to our projected plan rents over a 2-year period of time, we'll still be well below the average as of today on the 2-bed comps and still at the average as of today on the 1-beds.
Yep.
That's if the rents never moved at all the next 2 years for those comps. So that's part of what we want to build into our business plan is some downside protection to where we never want to be the highest rent in the market. We don't want to be the top dog. We want to be that middle more affordable apartment complex that more residents can afford, that gives us more opportunities to have that demand for our apartment complex versus the new shiny object in town.
Yep. And maintain our occupancy for all those reasons. But it's a layer of conservatism we have that built into the model for sure. This is just a rent comps map of all those things laid out about where we sit. Current A12 is very much in Clarksville. Walcott actually sits on Jeffersonville, but those are much closer to the river, highly amenitized. And you saw where those kind of sit. Current A12 is probably one of the more premium products in the area. Sits right on the river, a big revitalization project. Slate's right across the highway. There's also the Warren in there. That's a little bit newer. It's still in lease up deal. And then you have a big concentration of these products, and that's where you saw some of the softness of occupancy right there in that corridor of proper Jeffersonville. And that's where that other retail node is. And then Flats at River Ridge, that's kind of a flyer out there, but it sits next to the River Ridge Commerce Center exactly. And so that's kind of the layout of there. And there's several other apartment communities that are a little bit older vintage. We sit next to a few, but these are the main comps that we see in the market. So, kind of going into the sources and uses of what we see with this property. Like I said, we're going to be looking at a total equity amount around 19.7, just underneath there. We're looking to get a senior loan from the agencies, which will be fixed financing with some IO in it, non-recourse, around 37 million-ish dollars. That rate is targeting around 5.35. There is some volatility. We have some cushion built in there, and we'd probably be looking at taking down a buy down, and that's kind of reflected in some of our closing costs when it comes to the loan agreements. But all you get in there, total cost is going to be about 57 million or $184,000. That LTV will hopefully break out to around 70%. That'll amortize over 30 years. It'll be a 5-year term to coincide with what we plan on holding this investment. You can see some of the information breakdown of the specifics per unit on the operating expenses, and this will kind of segue into the pro forma that's in the slide deck. If you take a look at that, most of these expenses we either are performing at the property currently and have sign off by the PM company, or we're doing it at our other properties and see some synergies there, or have quotes back from our third parties, as goes insurance and some other things. And then the taxes that you're seeing reflected in there are the fully baked taxes and that are going on at the property currently. We will be charging a 1.5% acquisition fee on this one, asset management of 2%, dispo fee of 1%, and a refinance fee of 1%. Those are the
Thanks,
fees
Chad.
baked into the property.
Yeah, thanks, Chad. And like I was saying, those are all included in the projections. Your limited partner investor returns are all net of all those costs. So we've already baked that into your total investor returns. One note here on the debt side, kind of going back to the last struggles people have had in a lot of the last 5 years. One of the most common things that people have mentioned is they went with high leverage debt due to cheap interest rates and shorter loan terms. One thing that we've always done here at Focus Capital, we've always done longer term debt, always done fixed rate debt, and not high leverage debt. This deal is no different. So we'll have lower leverage debt here, fixed for 5 years, interest only 36 months, a low rate, non-recourse loan. This is one of the areas that we can provide the best way to lower the risk on an asset to keep it and be able to have the runway to manage it the right way. Go ahead, Jared.
So as Chad mentioned in the beginning, some of our high level metrics are that 15+% IRR and the 1.9x equity multiple. Our main goal with this property is all of your distributions plus your sale proceeds on this will basically double your investment. So at the minimum investment of 100K, you'd be getting a return of your original capital plus about 91K if we just meet our targets. And then as you saw on a previous slide in the very beginning, all of our exits have either met or exceeded their targets. And so with that, you also have your 8% pref, which Chad had mentioned, which means that for any years where your cash on cash distributions doesn't meet 8%, which here we have modeled out for the first 2 years, that money is still accruing and will be paid out in a pref catch up at the end of the hold cycle. What this basically means, in just kind of really basic terms, is we want to make sure that our interests and your interests are aligned. And so we don't participate in any property profits until you get your pref. This is a fail safe for you as an investor to make sure that we are aligned in our operations and our asset management and making sure that we are doing the best possible job at managing this asset and increasing that NOI and increasing the valuation of the property so that at sale, we're not only able to hit those targets, but also hopefully exceed those from a profit share perspective. Everything that is shared beyond the preferred return is split 80% in your favor and 20% in our favor up until the targets that we had set. And then we split it 50-50 thereafter. Any questions on this slide, feel free to drop it in the chat, and then you guys can just let us know from there. Some of the risk considerations on this is, not every single deal always goes smoothly, and we also want to kind of be upfront with that. If investing were risk free, everyone would do it, and so obviously you would want to be compensated for the risk that you're taking. The first risk that we kind of look at is what kind of recent supply has come into the market and will be coming into the market, and then is there going to be any lease-up competition? Chad Olson kind of addressed this a little bit when he was talking about the local comps, but the Bend is already at a 95% occupancy and it's fully stabilized. It's a newer build. It has all those amenities. And then we don't have a lease-up period on this. There isn't any reno risk as well on this. It's not a value add deal, so we won't be needing to do any of those when we're coming in, and that's reflected in our CapEx budget. The pro forma vacancy is also modeled conservatively, so it's actually modeled currently at the in-place performance. And then we will be obviously driving more occupancy to that area and then increasing rents on that side. The exit cap rate expansion. Everyone wants to know how it's going to look when we're exiting here. The base case, which we have a sensitivities slide that will be coming up here in a couple slides, assumes a 5.6% exit cap, which is consistent with the current transactional activity and with similar products that have exited the market. And then this also delivers from a sensitivity shows that at a 14% LPIRR, even at the 5.8% cap rate, which would be just barely below what our entry cap rate would be. So we're assuming at the base case at a 5.6, and then we'll have some optimistic returns there as well. So even at the most conservative level, this is still a great investment for us to be making there. Won't go too much into the tax extended dependency, just because this is contractually guaranteed through 2040. Another advantage that we have there is that when we do go to sell after the 5-year hold, this is fully transferable to the next buyer. So this also adds value to the property when we go to market with this. And then our debt structure risk. The Bend will be financed the opposite of the deals that got into trouble last cycle. Chad Sheeler talked about this. He made a note about this earlier in the webinar. But these would be the top main concerns, and then also how we at Focus Capital are looking to mitigate that risk. So bottom line, we've underwritten to these risk premiums. We know that there are certain factors that are inherent to any type of investment in any type of asset class. But what you're really trusting us with is that we're aware of those risks and we have plans on how to mitigate those and operate with those in tandem. This
Thanks,
is the
Jared.
sensitivity.
Good.
This is the sensitivity analysis. So this is one of those things that I was mentioning earlier. Even at our most conservative side, where if we only exited at a 14% IRR at a 5.8% cap rate, we'd still be hitting an equity multiple of 1.8. Our projections are at a 1.9, so we're still having a good investment. You'll still be profiting off of that 100K investment, but that's the most conservative. And on our optimistic side, we'd be hitting that 2x at a 16.4 IRR. So this kind of shows you the probability of those. And like I said before, all of our full cycle deals, 4 now almost 5 within this next month here, have either hit or exceeded our target goals and projections on that point. Chad?
No, go ahead. Go ahead. I was going to make a note real quick about one of the items on the risk slide, but go right ahead.
Yep, nope. I want to. Okay, why don't you make that note, and then I can kind of go into our next step slide.
Yeah, we had a question come in actually during this, which made me think of the risk slide and the returns. The question was like, okay, where is the value add in this project? Kind of goes back to the business plan that Chad Olson covered already. And really, that's, I think, one of the best parts about this deal that makes it a lower risk investment is when you have a value add type deal to where you're going to have to go to do renovation risk and lease up risk and other risks involved there, that there's chances that can go wrong. With a core plus deal like this, a brand new deal, like Jared mentioned before, there's no renovations, there's no lease up here. It's already built, no large repairs to be done. That is really where the value is at, is in operations, like we covered already. So want to make a note about that. Go ahead, Jared.
We had dropped a couple of links in the description here at the very beginning of the chat. One of them takes you directly to a booking link for any kind of one-on-one questions, and then the other takes you to the offering link where you're able to see a very similar deck to this. There's a couple more slides that we have in there and look at kind of the investment as a whole and all of the paperwork associated with that. Our targeted close here is the beginning of October, and we are raising 19.7 million, as mentioned earlier in here, but it's actually a lot of people. I've had a couple of people that are on this webinar already kind of scheduled from there. So if you would like to schedule a call for any follow-up steps, just use that link that's in the chat here, and then we can send that out after this as well. If you're like, you know what, I like this deal already, I already want to move forward with next steps. The registration link is on every other slide in our presentation. It's the register investment button in the top right hand corner, and then we also dropped the offering link in our chat here on Zoom. Chad, did you have anything else that you would like to add before we take on any live questions? Or we do have a couple of prepared questions, but I would love to kind of prioritize any live questions unless either of you gentlemen have something to add here.
No, I'm actually good, except for I thought of this a minute ago. Some people like seeing more of the property. And in this slide deck, which should be in your email already, there's a lot of pictures in there. If you want to see a drone video of this property and get to know, like, okay, how's this whole thing laid out? Where's it at in that little sub-market? We've got a really great drone video on our website. If you go to focuscapital.com, there's a banner there that says seed new investment. You can see a nice drone video that shows the whole website. I'm sorry, the whole property, give you a better feel for how it looks, the quality.
Perfect. Are there any live questions? We got the one question that was submitted during the webinar. If you have any live questions, go ahead and submit it to the Q&A or through the chat. And while we're waiting for those, we have a couple of prepared questions. One of the prepared questions that was submitted in advance, and I'll let Chad Sheeler take this one, is are we taking 1031 funds or retirement funds like SDR?
Yes, thanks. Thanks, Jared. Yes to both. We've always accepted 1031 funds from investors who have recently sold their exchange properties. That's a unique timeline, right? If the bottom line really is if you've got an exchange, 1031 exchange, and you're looking at this property to possibly exchange the money into, book a call with me or Jared as soon as possible to get you into this process. We do accept those $1 million minimum investment on this deal. And then IRA funds, absolutely. Actually, it's a big way a lot of our investors invest their capital with us is through IRAs, 401ks. We've got a very simple process that works with these self-directed IRA companies. We have two firms we work with mostly, but we've had a lot of investors use this as a way to take more control of their retirement accounts and self-direct to put it into real estate, a portion of it, along with their stocks and bond investments.
Another one of our questions, and I'll take this one, is how are distributions processed? So our distributions are processed quarterly. We initiate on the first Monday of the trailing second month. So February, May, August, and November for the previous quarter. We, as a company, once we've started distributing on a property, historically have never stopped distributions. We haven't had a capital call or lost any investor dollars. And those will come straight through our investor portal. So if you go to the investor portal link and you register your offering there, you'll be able to, it's super simple. You just input the account that you would like your distributions distributed to, and then those are initiated there. Along with that is also the same reporting cycle that I had referred to earlier on our quarterly reports. Those come out on the same day as distributions are initiated. The quarterly cash distributions for this property specifically are targeted for Q1 of 2027. Another one that was prepared was what are the potential tax benefits outside of the property tax benefits on all of our properties. We do have a cost segregation study done, and we're on this one. We're going to be close to an 80% year one accelerated depreciation. So those would be passive losses to offset passive gains, and those will be distributed to you via K1, and those will count towards the 2026 tax year.
Jared, I think it's helpful to maybe really break down the numbers for some people. So what that means really for investors is if you were to invest, let's call it $200,000, that means the estimated K1 passive loss on the first year is $160,000, 160. And you could use it for other passive gains, passive income, to roll it forward. That's more of a CPA question than for us, but that would be a large tax advantage from this investment.
I think we have one more question. And let's see here. And I think this one will go to Chad Olson. When does the hold period begin? When is the targeted exit? And is there a case that you would ever sell early?
The hold period will begin when we close, which should target around that October date. We'll hold it for about 5 years, and so we'd be looking at 2032-ish. 2032, but by the time we close, and then a few months, give or take, in there, or end of 2031. And as goes sells early, yes, it's always a possibility, but the only way that happens is if we can deliver the return or better than what we projected to our investors. That would trigger that point in time. And we obviously own the other properties in the area, so that is going to be always a consideration with whatever the best strategy is to disposition that and return the capital.
Perfect. I think that's all the submitted questions that I have on my end. Chad's, do you have anything else that you would like to add?
Yep. We have one more here. It says, how are the taxes baked into the exit or sale of the model? Chad Olson, that's you.
So we kind of we set from the top, and Jared and Chad kind of alluded to, we have the going in cap rate and we have the exit cap rate. And these things do not take into account the the TIF bond. We kept that kind of separate and applied a net present value to that in the same way that that bond was created in the first place. And so right now the pro forma, and you can see that when you look at that slide when you're looking at the deck, there's fully baked taxes in there. So we are just looking at the property as a whole and then looking at that TIF bond separately. It's taken into account in the cash flows because it is an actual cash flow that will come back to investors during that period. But as the time of sale, it's going to sell differently. And so that cap rate that you're seeing, that exit cap rate, is based off the fully fledged taxes at the time of sale that will be appraised and assessed. And so that's another layer of this conservatism that you could bring that into NOI lines and then apply that same cap rate. But then that adds layers of risk, I think, to it on how a buyer would be underwriting that. And that's how we underwrote it here on the front end. We're going to continue that from what we got feedback wise looking at it. And think that'll and applied a little bit higher discount rate to those bond payments as well. Which I can happy to go into with anybody if there's a deeper question on that.
Chad, I think to put it simply, for at least for my sake, I like this part. Really, what it means to me is, okay, year 5, we're going to plan to sell the property. Instead of taking the property tax reimbursement amount of that $475K per year and putting it, including in our NOI, which affects our value, we're putting it below the NOI line, which is still affects cash flow positively, but it's not going to be impacting the sale amount we're projecting in 5 years that another buyer would underwrite to. So what it really means is we're being conservative to where we don't want to have any situation where our returns are based upon an overinflated valuation of 5 years. We're being conservative in this case.
Absolutely.
One question I got here is, okay, who is in control of the deal operations? That's me. So, sorry, this is the question for me, really. So the question probably came about is other groups will have multiple different people involved. I think it's helpful for every investor to know that there is one group that's in charge of this asset. There's one team in charge. It's not multiple people that are doing different things. And that's helpful for you to know, to where you know that there's one company making all the decisions to make this asset run really well. So it's very efficient here. We have Andy, Chad, and Jared on board here to get this all done. So that would be a good answer to that question there. Anything else, guys? More questions? Last thing I'll say is thanks a lot for your time today. As I've built this business in the past, I've met people in person so many times. If you're local here to Indianapolis, meet us at our office. Let's meet for lunch or breakfast. You can fly out and see the property with us as well. Do a property tour there. Happy to do it with you guys. Not a problem at all. But thank you all for your time today. Like Jared said, to book a meeting with us directly, the link's in the chat there, as well as the link to our portal in the chat as well. Thank you all, and we'll talk very soon.